So I'm supposed to be at the gym right now, but my wife is still working. So here I am squeezing some few minutes of filming in before I set some PRs.
Later that same evening.
Careful.
Today, I want to talk about bonds. So this is going to be one video out of many relating to investments, stock markets, and how to build your wealth through those equities versus buying real estate. All right, so I have many friends and viewers who asked me, hey, if I could make videos on this topic, on these type of investment topics, because some of them actually have a lot of money sitting in the bank account. Since it's sitting in the bank account, we all know it's not growing, but they just don't know where to start, and all the information is a little bit overwhelming. So hopefully I can break it down piece by piece through these videos, and hopefully it will make sense. And obviously, if you came here just to hear the exact reasons why I don't have bonds, you can skip to this timestamp or wherever I will put it here. Otherwise, sit tight, learn about what bonds are, learn about investing, a little bit more about investing, and hopefully then it'll make sense when I tell you the reason why I don't have bonds. Let's talk about risk. Now, risk is a little bit tricky because the definition for risk might differ depending on where you're coming from. But in the investing world, high risk means more likelihood that you might lose your money. But it also means higher returns. And a low risk, which means there's a lower chance of you losing your money, means lower returns. You see the correlation there? They're directly correlated. Now, I will say that all forms of financial assets have risk associated with them. Even cold hard cash has risk associated with it. In this case, it would be inflation. When you keep money in a bank account or as cash and you don't invest it, then over time, the value of that money will go down due to inflation. And that's a risk. So when we say losing money, we don't mean, you don't have to lose all of your money, but it's just the fact that your money might be worth less in said investment than if it was invested in something else. Right off the bat, I will tell you that bonds are a low risk investment. Generally speaking, you won't lose a lot of money on bonds, but you also won't make a lot of money. Right? It's a low risk and safe investment. Now, on a high level, a bond is an investment based around debt. What it means is that an entity will borrow money from you, and then they will promise to pay you back a certain amount of money or interest rate on top of the original money that they borrowed. Now, just to give you a quick example, in case you see some of this terminology out there in the wild. For example, company XYZ issued a 10-year bond for $10,000 with a coupon rate of 1%. Over a 10-year period, company XYZ will pay you 1% of $10,000 every year until the 10th year, in which case they'll pay you back $10,000. Every year, you'll get $100. Now, obviously, one of the biggest problems of bonds is that what if the entity that you lent money to went bankrupt or they can't pay you back? That's a big risk. That can happen, but it's less likely or less risky than if you were in the stock market where things would change in value every second. Now, how do you get bonds, right? I gave an example of a company, but really bonds can come from many places. And the most famous probably is the US Treasury bonds. And you can get US Treasury bonds from Treasury Direct. And I know it looks like a sketchy kind of site if you go on it, but it does work. And don't take my word for it. Do your research. Right? Just do a quick Google search on how to buy U.S. Treasury bonds, and you'll find a bunch of information. And also you'll find that some .gov sites actually lead to this site so that you know it's trustworthy and it works. There are a lot of reasons people buy bonds. It's a predictable stream of income. You basically know how much money you're getting and when you're getting it. In our 10-year example, you know for a fact you're going to get $100 every year up until the 10th year. It's also a safe investment when it comes to a recession because although stocks generally do drop in value during a recession, bonds will pretty much be unchanged. If you do own a bond, you should have no issue receiving payment on time given the company or the entity doesn't go bankrupt. Right? So the US Treasury will pay you on time because generally speaking, they've never defaulted on a bond before. It's also great for diversifying. So it's a safe investment, and you'll see a chart somewhere that I'll post here, or you'll see in the visuals basically showing you that while we had recessions during 08, 2020, and so on, you notice that bonds have stayed relatively flat, but you don't see them going up either, right? They're very steady. But if you look at the stock market, you'll see that it plummeted during that same time period. So generally speaking, it's safe and it's a good place to park your money if you don't want it to fluctuate too much. That part also makes it great for diversifying your portfolio. I've heard the saying, don't put all your eggs in one basket. This is another lesson when it comes to investing. Make sure that you have money in a lot of places and not just a single area or a single asset, because that's not a safe or smart way of doing it. Because if you lose all of your money, it's going to be gone, right? Versus you want to make sure that you have some in bonds, you have some in stocks, and so on. Okay, well, those are a lot of good reasons. Now we get to the part about why I don't have bonds, right? I've listed a bunch of great reasons to have it. Now, why don't I have it? So there's two big reasons. The first one is that I'm not afraid of a recession. A lot of factors that go into this, and it's basically something that will vary depending on your own personal finances, right? And what you are comfortable with. But the things that make me feel confident during recession is that I'm in a great competitive industry, which is software engineering. They're constantly hiring even during a recession. So I'm not too afraid that I'll be out of a job for long. Right? I might lose my job, but at the same time, I'm sure I'll find another one without too much trouble. So it really depends on the industry you're in. If you feel like you're in an industry that's really hard to find a job in and a recession will impact it particularly hard, then maybe you want to reconsider at this point. The second thing is I'm in a dual income household, which means if I lose my job, my significant other is still going to have her job, chances are. It's not too terrible. We're not really going to be without income the entire time. If we both lose our job, that's also another thing to think about. In that case, we have an emergency fund. And for all of you who are watching right now and you want to invest, make sure before you invest, you have an emergency fund. Right? It's one of the most critical and one of the most important things. So we have an emergency fund of somewhere between 3 to 6 months. Right? So what that means is if I lose my job tomorrow, I can go without a job for 3 to 6 months and still pay for my mortgage, pay for my essential living expenses, and then I'll have that time to find a job basically. So all in all, what that really means is I don't have to sell stocks or sell my investments during a recession. If you do need to sell your investments during a recession, you would want to have bonds, right? Because that's the thing you want to sell because its value hasn't fluctuated a lot. And if you sell stocks, you might miss out on returns later that year when it does recover, or later in the future when it does recover. So you definitely don't want to sell stocks or riskier but higher return investments that might be down during the recession. And the last point here is that I'm young. I'm not saying that, I'm young as a person age-wise. I am, but that's not the point. The point is that I have a longer time horizon. My financial goals have a longer period of time that I'm willing to invest. Right? If I lose all of my investments tomorrow, if everything I own, a 401k, IRA, and so on plummeted to zero, I would be okay with that. I wouldn't be fine with that. That kind of sucks, but I would be fine with the fact knowing that I would still have 40 to 30 years to still prepare for retirement, right? To still save for retirement. That might not be true for everyone here. Right? Some of you might have shorter time horizons to retirement. Others might feel that you're investing for a different goal, right? Maybe not retirement, maybe for purchasing a home. So those shorter periods of time, you might want to have bonds for those investment goals. But just keep in mind that bonds don't grow as fast as stocks, as we've seen in the previous charts. So what that really means is if I hold bonds for a long period of time, that's money that's not going to grow for that period of time, right? It's safer. That's the whole point of it, but it won't grow. And I really want all of my money to be working for me and growing. So that's a big reason why I don't have bonds. Right? Bonds are so beneficial. At the same time, there are downsides to it. So when will I get bonds? I think in terms of retirement, I'll get bonds when I'm 5 years away from retirement. Really start allocating more of my assets toward bonds just because they're safer and they're steadier. And when I do need to withdraw money in retirement, I can be sure that I can withdraw money from bonds versus selling my other assets that are more volatile and maybe low during the recession. I also plan to allocate 25% of my investments into bonds. Right? I didn't pull that number out of thin air. There is research behind this, backed by historical data. And you can look up the Trinity study, and I can link it below as well. Basically, this large study that they did based on historical data to determine how should I invest my money so that I don't run out of money in retirement. It's like a high level way of putting it. And the last point here is I want to be clear that I'm probably not going to purchase individual bonds. Probably just going to buy bond mutual funds. And that's the same thing I showed you in the graph too. They're bond and mutual funds. In other words, if you're not familiar with mutual funds, instead of buying a single bond, I'm going to buy hundreds of bonds all at once so I can be invested in multiple areas. A bond still has risk. If the entity that borrowed money from you can't pay it back for whatever reason, then you're out of luck, right? So I want to make sure that I'm invested in a lot of entities that, basically owe me money. The chances of them all failing to pay back is unlikely. It's possible, but it's very unlikely. Hopefully that was helpful. If you're trying to invest, hopefully this would give you some insight into bonds and investing. And if you haven't started, this is me telling you, encouraging you to start reading up more, or just keep watching my videos. I'm going to touch upon the idea of stocks, the idea of mutual funds soon, opportunities to invest that might make it easier and sort of like the lazy form of investing, so you don't have to think too much about it, but still grow your money. But otherwise, like, subscribe, and comment, and I'll see you in the next video then.